let's see. All right. So that's enough about us, about JJ Lake, and also about Oriza Holdings. We are initiating this event also because Oriza Holdings pays close attention to SPACs and hope we can learn from the best today. If audience are interested in learning more about Oriza and JJ Lake, I was the one sending out the Zoom confirmation, so you can easily find my contact information there. So today we're talking about SPACs. So it's a recent capital market phenomenon. And we have a great panel today. Panelists are from very diverse background. We have a commercial bank, we have investment bank, and we have law and tax firm. We're very honored to invite for executive to share their points of view regarding the SPACs. So just in case many of you, the audience, might not familiar with our speaker today, maybe we can ask our panelists to start with a self-introduction for about 1 minute each to tell our audience more about yourself and the firm you are representing. Who would like to go first?
I'll start.
All right.
Okay. This is Rob Matlin. I'm a senior corporate partner with K&L Gates. K&L Gates is a 2,000 strong global law firm. I specifically head up our SPAC practice and have been involved in SPACs on and off for about over 20 years now. So we've seen all different iterations of the SPACs, and our specialty is we can do the SPAC IPO, we can do the de-SPAC transaction, and we work on many of the pipe deals also. So we understand all angles of a SPAC transaction. Next.
I will go. Oh, go ahead, Lisa. Please,
okay.
Lisa.
So I work for Barclays Technology Investment Bank in the Silicon Valley. My main focus is on technology M&A. So in terms of how Barclays can help companies with SPACs, we can help SPACs issue, SPACs go public. And then we can do either SPAC buy side, help the SPACs find targets. We can also do company sell side, trying to sell a company to a SPAC. So this is the M&A portion, and we also have capital markets team. They can run the pipe process. And after companies announce this de-SPAC transaction, then we hand it over to law firm.
My name is Vivien Wang. I'm an international tax partner at Deloitte. I'm certainly quite familiar with HISTA. Has been as Deloitte overall has been a sponsor and friend of HISTA for years. And so my own technical background is really tax structuring, and certainly in all the SPAC transactions, this is fairly critical piece of it. And then my other role in the firm which is lead our China practice for the US firm. So in that role, I deal with quite a lot international SPACs in the recent, actually 2 quarters. So another fairly unique aspect in terms of how to fit a China or international structure into a US SPAC and still achieve the ultimate sort of corporate agenda for investors globally. So certainly Deloitte is a all service firm. So besides tax, we have audit services, which is critically important. And more importantly, we have built out a very robust IPO readiness or SPAC readiness services. So even we're not your auditor, we can take you through the journey, which a couple of slides on this presentation will sort of flash in terms of what are the critical moments that Deloitte can help. Thank you.
Thanks, Vivien. Lee.
Hi, everyone. My name is Lee Song. I'm a managing director at Silicon Valley Bank's Asia Link practice. Silicon Valley Bank, or SVB, as you know, is the go-to bank for innovation companies and investors around the world. The Asia Link practice is serving as a bridge between tech companies here in the US and tech companies in the greater China area. I want to thank to the audience for joining us today, and also thank you, Yifu, and our partners at JJ Lake for hosting this event.
Thanks, Lee. Thanks for the kind word. So, well, just in case some of the audience might not know SPACs well, like myself, I have prepared a definition slide. So the full name of a SPAC here, I will read it for everyone. So the full name of the SPAC is a special purpose acquisition company. And the definition here is a special purpose acquisition company. SPAC is a company with no commercial operations that is formed strictly to raise capital through an IPO for the purpose of acquiring an existing company. Well, if you are still confused, don't worry, we will get there. So let's first look at the slide that shows us the SPAC IPOs versus the traditional IPOs in terms of the deal number. So in the last year, we can see that the traditional IPOs have been outnumbered by the SPAC deals. So my first question here is, what's going on there? And what's the factors driving this SPAC popularity? Anyone would like to jump in?
Yeah, I'll start again. Sorry about that.
Yeah.
The SPAC popularity is being driven by the ease and speed compared to a traditional IPO. And the SPAC is really an alternative to a traditional IPO. So it's not an acquisition per se. It just gives the target company a specific amount of net cash that they know they'll receive when they sign up their merger agreement with the SPAC. And this way you don't have the doubt, like in a traditional IPO, you spend 6-8 months working on it. And then at the end, you know what you're going to get. Here, after 2 months of negotiating with the SPAC, you sign a merger agreement and you sign a PIPE subscription. And that provides the cash proceeds to fund the operation. And it really is a faster process with more definitive outcomes than a traditional IPO.
Yeah, so from a capital markets perspective, I think, the whole SPAC wave started amid the coronavirus pandemic. I think the remarkable volatility in the equity markets seem to have unleashed this equity product. It has been around for multiple decades, but it was all of a sudden popular again, starting 2020. I think what Rob just mentioned, that was the fundamental structural change, right? Investors are way more protected compared to back in the 80s and 90s. And on top of that, I think for this wave, for a SPAC or de-SPAC to be successful, you need a willing buyer, willing seller, and a willing PIPE. So on a buyer perspective, there's an increase in founder quality. You can see some really seasoned executives trying to, organize their own SPAC. So, high-profile sponsors are elevating the product's credibility. In terms of willing investors, a diverse set of investors are looking to set up SPAC dedicated funds. Also, from a seller perspective, as this product gains credibility, sellers are increasingly view SPACs as a viable exit alternative. So they're more willing to engage compared to before. So I think that's kind of also the recent equity market rally has provided a tailwind for SPAC market activity.
Yes, so many reasons are driving the SPAC forward. So my next question, I would like to ask each individual panelist. So what kind of a role your company is playing in SPAC transaction, and what have been your clients' view about SPAC, and how are their reactions to the SPAC boom? Maybe this time we will start with Lee first.
Of course. Well, SPACs is certainly a hot topic among our clients. What we do at SVB is that we put our clients in the center, and then we search around our global platform for resources so we can serve them, we can help them. And for example, our client advisory team opens bank account for SPAC sponsors, the holding companies, and then our capital market team, which is called SVB Leerink, directly underwrites life science related SPAC IPOs. And also our tech bankers, our buyout teams will go through their portfolio companies and then look for those public market ready portfolio companies and then introduce them to high quality SPAC sponsors. Even after the SPAC merger or the de-SPAC process, our debt team will meet with the finance team of the company and then present them with a whole host of debt financing options for them to consider. Because insiders know that debt financing are usually cheaper than equity financing in the short term and long term.
Thanks, Lee. Lisa, how about your view?
I alluded, as I alluded earlier, we can play multiple roles for a SPAC process. So taking a SPAC public, that's from the SPAC sponsor perspective. And then once a SPAC is public, we help them find targets and do fairness opinion, take them through the M&A process. From a seller perspective, we can advise them, we help them prepare financial model, prepare investor presentation, and then introduce them to potential buyers, and then we take them through the M&A process. And in parallel, we can also run the PIPE process. So, introduce them to the private investors and take them through the term sheet negotiation and all the way to announcement.
Thanks, Lisa. Vivien?
Sure. I sort of mentioned a little bit earlier, I think the main function from a Deloitte perspective is number one, we can be your auditor, which is must-have element in order to be a public company. So hopefully, if you're thinking about SPAC, you already have one. If not, it's going to be very hard to get in today's market. Now, another piece is SPAC is a fast and furious process, different from a traditional IPO. So sometimes company is not as ready. So our accounting, typical auditors, we turn around and become your advisor. So we can be the supplement to your internal finance team and get the company ready. That's more of advisory services that we provide. And myself as a tax professional. So again, there's going to be an acquisition going on. So there's a lot of transaction-oriented tax issues, executive level of tax considerations, stock option and equity comp related things. So we assist a company thinking through all the tax elements to make sure the buyer and the target are satisfied with the ultimate tax consequences.
Thanks, Vivien. Rob?
Yep. So as the legal team on the SPAC process, we basically make everything happen that Lisa, Vivien, and Lee just talked about. We're the army for you. So from getting the documents ready to making sure the M&A happens, the PIPE transaction happens, the registration statement with the SEC, getting you public. Yeah, again, we're the army, and I sort of act as the general with my firm's team to make this all happen. It's a lot of work for everyone, but we all coordinate very well with the bankers and the auditors and the tax structuring. And that's what's really key, is tight coordination and communication and keeping the client informed.
That's a lot of aspect. Thanks everyone. And here's next slides. Oh, by the way, thanks for Deloitte. Thanks to Deloitte for providing the slides. It's a very professional explaining the SPAC milestone. And my next question goes to Vivien and Robert here. So is the SPAC a faster process comparing with a traditional IPO, and what's the difference out there?
Vivien,
you want to go?
Vivien, you can go.
Okay, I will just go. I mean, I think the fact that most of the SPAC has a time table, right? Either 18 to 24 months. So typically when and we typically represent on the sell side, meaning the target side. So when the target meets a SPAC, there's basically a set timeline. And everyone's very motivated to meet that timeline, especially if they already have pipe identified as well. So from that perspective, I do think the SPAC is faster than a traditional IPO, because the traditional IPO, there could be a lot more other considerations, market and all those kind of things. So I would also, based upon my experience from a due diligence perspective, SPAC is faster as well. So yes, overall timeline wise, it certainly is shorter, but yeah, maybe we'll touch upon this later. But I think a lot of companies may be less ready. That's also is the challenge. So it feels even shorter than a traditional IPO.
Right. That you're correct, Vivien. You know, in a normal time frame that you set for a SPAC, it's probably 5 to 6 months, as Lisa and I were discussing last week. A traditional IPO is more around the 8-month period. The SEC process and review is much longer on a traditional IPO, although with the new Biden administration coming in, people are expecting tighter reviews as we go forward, but that's something we'll have to see in practice. The magic is since this is an acquisition, it falls under a different regime of review, and you're allowed to use projections, which is part of the fuel why this can move faster, as opposed to in a traditional IPO, everything you're talking about is in the past. You don't say anything about the future. In the SPAC transaction, everything's about the future growth. And that's what the company and the SPAC are promoting to the investors. And that's why. And it's not, you shouldn't look at the SPAC sponsor as an adversary, like in a normal transaction. They really, once you sign the letter of intent and the merger agreement, they become your partner. And since they're already public, they are also motivated to move things along very fast, because that's the only way they make their money. So that's what's driving it also.
Thanks, Rob. Vivien previously just mentioned that it's debatable for a company whenever they're ready to go IPO approach or the SPAC approach. So my next question goes to Lee and Lisa. So could you paint us a picture of an ideal company that's ready to go public through a SPAC merge?
I can certainly take a first stab on that. After talking to enough SPAC sponsors going through our portfolio clients, also our portfolio clients wanting to go to the SPAC process, I can definitely see the sponsors are under a pretty tight deadline to have the merger done, as we all discussed. So they may look through quality companies or less of quality companies in the whole process. But my observation is that the SPAC merger ready candidate should have be ready in 2 ways. Number 1 is the business model. Number 2 is the corporate setup. The business model perspective is that the company needs to demonstrate the potential for long-term value creation. You can compound the growth. And also the company should be able to win in many different ways. For example, whether it's vertical organic growth or horizontal expansion, or even outside alliance. You got to have that capability. And when you reach the stage that you have the core business model, technology, client base, all essentials buttoned up, you only need outside capital to fuel your next level of growth. And also the SPAC sponsors' expertise and network for your future growth. That's when you're SPAC merger ready from a business model perspective. And from a corporate setup perspective, that's relatively straightforward. And everyone on the panel can help. That's the internal control, compliance, finance, accounting system, all that type of thing. One example of a good SPAC merger is a company called QuantumScape. The ticker is QS. It's an EV battery play, went through the SPAC merger 6 months ago, and its stock went up 600% after that process. 6 months, 400%, sorry. It's quite a success story.
Well said. Lisa?
Yeah, I completely agree with Lee. What I would add is I think there's no one type of company that's ideal for as a SPAC, as a de-SPAC candidate. So we've seen different types of companies who went through the SPAC process who are doing well, right? So one type is what Lee just described, the companies with a focus on growth, and the company has disruptive technology, deep tech, and this type of companies tend to do well. Also, we've also seen some high quality businesses which are not high growth, but really good fundamentals. They can do well too. The other type is more, the mission-oriented SPACs, which is what Lee just described, QuantumScape. So along with a bunch of LiDAR and EV companies, we just took another one public called Lilium, who does the electrical airplane, right? So these are, you can call it ESG related companies, environmental, social, and government, those type of companies, they tend to do well as well. So I think the company has to be a public ready company. And that's you have to make sure everything is on track. If you go through the traditional IPO route, you're going to do well. Then I think if you do the SPAC, it's going to shorten your process. So I think that's kind of a prerequisite.
Thanks, Alyssa. Well, next, let's put ourselves in entrepreneurs' shoes. So my next question goes to Rob. My question is, will I lose control as an entrepreneur? Will I lose control of my company in a SPAC deal? And what happens to my current board of directors? And also what happens after I close a SPAC deal?
Okay, thanks, Yifu. We'll start the answers backwards. So once you close a SPAC deal, you are now a public company with full reporting obligations and the eyes of the world watching you. So you have to be prepared to communicate with the public markets all the time. If you're the CEO or CFO, you've just added about 25 to 35% to your day job. So this becomes a whole new work stream of responding to investors, responding to lawyers, responding to a whole host of other people. So you have to be prepared for that. In terms of losing control of your company, you're going to probably end up selling about, I want to say 20 to about 30% of your company post de-SPAC transaction. So you end up somewhere 70%, I think is the normal math after you look at the SPAC existing shareholders and the PIPE investors that come in. But the good thing is you've gotten a great valuation, which hopefully only goes up, as Lee described in one recent example. There are plenty of others that unfortunately trade down, but that's the risk of being public. That's why you try to get a good amount of IPO proceeds, net cash, to fuel your growth. So you won't lose control. You'll still be the CEO and chairman of the company. Your board will stay the same, except you'll add a majority of independent board members, which 1 or 2 will come from the SPAC side. Maybe you'll have 3 or 4 that you add, and then you'll look to add people for that add value to your company from a public perspective. Diversity of board members is something we have to be sensitive to, especially if you have any operations in California. That's something to consider because they recently passed a new law. And NASDAQ is looking at having some requirements of diverse people. But remember, the board is your friend. They may look independent, but they really should all be your friends and supportive of what you want to do.
Well, as long as we can secure a good lawyer from KL Gates. My next question goes to Vivien. I understand that you have extensive tax planning and structuring experience. So in the recent SPAC deals, what are few common tax planning issues company would run into during the SPAC process? Yeah,
I mean, maybe I just run down some planning opportunities as well as issues. I think, especially for this audience, for a lot of entrepreneur plays between US and China, you might have a Cayman headquarters structure. Most of the SPACs are really US company. So do you want to retain your future listco as a foreign private issuer and foreign from a tax perspective versus become a US entity? That should be, really well thought through. And if we want to retain the foreign status, that there's quite a bit tax issues to work out. Okay, that's probably a biggest ticket item. We don't have time to go dive deeper. Maybe that could be our next session topic. Another piece is very commonly run into issues executive compensation. Once you are US public listed company, there is a whole list of corporate tax rules will limit deductions for, executive comps. And also that list who consider executive is expanding under the new proposal. But at the same time, you want to align your executive compensation with your shareholder interest, right? So there's HR element to it as well as tax element to it. And on top of that, certain SPAC deals will trigger acceleration of vesting or not, depends on how your stock option plan was drafted. So there could be financial statement impact as well as tax impacts to the individual and the corporation. And I think last but not least to mention is SPAC typically have a fairly certain, appreciation because you negotiate with SPACs on your price. So for founders, how much you're going to make on this deal. You need to plan ahead for your individual income tax. So I see some of people did not do it. And then, sort of like, what do I do now? So I do think that's something to watch out for as well.
Thanks, Vivien. My last question regarding SPAC timeline and milestone goes to Lisa. My question is how to pick the right SPAC partners. Can you elaborate more on going public through a de-SPAC process?
Yeah, so as of last Friday, there were 428 active SPACs looking for targets. That's a total of 140 billion of capital waiting to be deployed. And there were 248 SPACs on file waiting to go public. So that's another 62 billion of capital. Altogether, we have 200 billion capital waiting to find targets. So it's a seller's market. I think for private companies who's looking to go public, good news is you do have a lot of candidates to choose from. But you also need to be really careful who you work with, right? So, I think the right SPAC partner, first of all, they should be a well-known sponsor with a strong sector and market understanding. Ideally, they have successful SPAC track record. I know some SPAC sponsors, they're launching into their 8th, 9th SPACs, starting from last year. They just go deploy one and then come back and raise another. So a lot of those have very good track record. I think because they went through so many processes, they already have a really good relationship with PIPE investors. So, make sure they have a relationship with, a strong base of fundamental PIPE investors who can help you set the valuation target. It's kind of a really good validation point for the companies before it goes public. You know, there's also potential strategic benefits. The right sponsors can help the company grow, you know, introduce customers or, you know, bring you into a really well-established, relevant network. And also there's a good culture fit, and you need to like the sponsors. And, you know, you want them to help you, but you don't want them to be in your daily operations. So that's also something, you know, you need to watch out for. It's kind of like an interview process, if you will.
Thanks, Lisa. Well, about SPACs, there are many controversial debates on the internet. So I took a screenshot and some comments from the internet. So as we can see here, SPAC IPO, SPACs have been underperforming the market in recent months, although this is data from last year, but as far as we can see, it's still the same situation. So my next question goes to everyone in this panel. So what are the unseen risks associated in a SPAC deal? What's behind there? Anyone want to touch base on this one?
I can comment on that. I think just based on our day-to-day execution in the market, we have seen a backlog of pipe on the road. So a lot of what worked through February this year is not working now. So pipes are kind of the gatekeepers in the market today. So most deals are getting pulled or renegotiated before getting announced. So we need to clear this backlog in the pipe process. I think it will take probably a few weeks or more. In terms of performance, investors are more and more cautious. I think the results of these SPACs are very binary nowadays. I think that just based on plain stats, the larger SPACs tend to do better. I mean, the larger SPACs, you have better sponsors and they're able to find better quality companies. So overall, they perform better. But smaller SPACs with less than 250 million in capital, they're kind of underperforming. So the chart you're looking at, this is the average. I think it's driven by the binary results.
Thanks, Lisa. And by the way, for our audience, if you want to raise question, because we have a Q&A session by the end of the panel. And if you want to raise question for our panelists, feel free to use Q&A to type down your questions here, and we'll make sure to go through your questions by the end. So my next question goes to Lee. Well, about the SVB's customer profile, we know that about 50% of some VC and VC invested tech companies in the US. And from our chat before, you always strike me as a forward-looking guy. So what factors will further drive the growth of the SPAC, and what factors could potentially slow the SPAC down?
Oh, thank you for the nice word on SVB. Well, we try to do better. I know we have limited time here. I'll give you one positive factor and one negative factor for the SPAC future. As the data Lisa presented showed that there's so much money chasing deals, I think the single biggest enabler for a continued SPAC boom is the easy money policy here in the US. The single biggest one. Of course, the government or the federal government poured so much money in the economy to stimulate the area that hard hit by the COVID, for sure. But money is fungible. It doesn't necessarily go where you want it to go. It'll always flow to where the risk-adjusted return is the highest. For now, the SPAC market is one of those areas. That's the positive side. I think the thing might serve as a speed bump or derail the SPAC boom is the tighter or heavy-handed government regulation. because SEC has been watching this area for a while, and they fired its first warning shot on March 10th by saying that retail investors don't make SPAC-related investment solely because of the celebrity involvement. It's basically saying that the celebrities can be duped into dubious transactions. So retail investors, be careful.
Thanks, Lee. Well, my last question goes to Vivien. We know that accounting is always one key element for IPO process. So what are some typical mistakes you have seen during the SPAC IPO process made by company? And what would you advise to our audience to better prepare from the accounting or auditing perspectives?
Yeah, I mean, so the biggest mistake is if people don't have an auditor identified before they actually getting an LOI. Okay, so and honestly speaking, given the volume of SPACs potential deal, as Lisa mentioned, all the big firms are super busy, and I think for U.S. listing, honestly speaking, Big Four typically the choices for audit firm. So I do think for companies you are thinking about IPO or SPAC or de-SPAC, you know, it's always best to build that audit relationship. If you don't have a big firm identified currently, but you know, then probably have to manage your expectation accordingly. And another piece is really be ready day one. I think Lee talked about earlier the corporate structure. I do think you know, the CFOs and the management should be ready to forecast, right? I mean, it is part of the SPAC process, but certainly a lot of companies are not ready to do that. So provide the right guidance and really understand the public company, there's GAAP versus non-GAAP guidance, and how does that really work? That's also a critical element to ensure once you're public, you can still maintain your or, you know, really strike for the higher price for your company stock.
Thanks, Vivien. Well, that wraps up the panel. Let me stop sharing here. We got many questions. Wow, that's a lot of questions. How do you guys want to answer this? Should I read the question and maybe you guys, if anyone want to touch base on this question, you may jump in. Okay, so let's start from the beginning. The first question is from Xinhua. The question is, for SPAC IPO, what difference does this make for employee with common shares comparing with regular IPO?
I can take that one. So what happens when you have shares or options, it all gets rolled into the new public entity, if that's the SPAC or some newly formed company. So you trade in at the same valuation. So it's really just like an IPO for the employee. It can be a great windfall, and that's why a lot of companies do go for the SPAC or the IPO, because it works out quite well to the employees.
Yeah, I mean, in very rare situation, because the SPAC can consider as acquisition, there might be even early vesting triggered. So that's also some of the things need to work through. And there's another, I don't know if it's really applicable here, but we certainly see 20% of SPAC IPOs in the format of partnership or flow-through entities. So those, if you're part of organization in that structure, meaning LLC structure, that equity compensation could be very, very complicated to manage.
Thanks, Vivien. Thanks, Rob. So the next question is from Wang. Based on your observations, do SPAC companies obtain similar valuations and the liquidity on the capital market as a traditional IPO?
I think that's a Lisa question.
Yeah, I think fundamentally you get similar valuation, but because of the uplift in stock prices after post de-SPAC process, right? I think on average, even now the market is a little bit down. On average, de-SPACs first day trading, first day trading, they're still up by 30%ish, and in a month it's still 30% up from initial IPO. So I would say it's case by case for sure. If you're a regular company, if you go the traditional IPO route, if you're a really high quality company, I think your stock will go up significantly too. But on average, I think there's a, you know, the SPAC factor here, your valuation might be slightly elevated. In terms of so in terms of liquidity, I think that's probably a question for you, Rob. The lockup period for SPAC is shorter, right?
Right. You know, it's interesting. So you sign a lockup when you're on the private company side, and they're ranging anywhere from 6 months to 12 months post-closing, but there are usually stock price triggers that can release the lockup agreement. I've been advising clients that a SPAC does give the highest valuation when compared to an IPO or a private equity exit or a strategic buyer exit at the end of the day. The question is, you know, a year out, 2 years out, we have to see how your stock performs, but that's the same as any IPO. You have to continue to perform well and not surprise the market.
Yeah, once you're in the market, it's all market driven.
Next question is from John. The targeted company is mostly with quite maturity. Is there any investor specifically looking for smaller company to help grow to the kind of company for SPACs, or something like mini or pre-SPAC companies? Anyone would like to take this one?
Lee, you want to handle that one?
I mean, the only thing I can think of is the SPAC IPO will incur cost for the sponsor. So if you do a larger deal, the economics will work better for the sponsor. If the deal is too small, there's a fixed cost you have to go through, anywhere from $8–10 million. You do the math. So that's what I can think of.
Yeah, if the company's valuation is relatively low compared to the SPAC size, then you get too much dilution from the sponsor founders share, right? They take 20%. So I think ideally the SPAC size is, ideally the company valuation is above 3 to 5 times of the SPAC size.
Right. It really comes down to, will your story play well into the market? So I'm working on one deal that's pre-revenue right now, but they have really killer technology and assets and really smart engineers. So, and they've been around, I think, about 8 years now. So it's something that we expect to be well received in the marketplace. And the sponsor is backing up to half of the pipe. So it makes it easier to get the deal done. At least that's what I hope. So.
Hey, the next question is from Vivien. So what is the difference between a SPAC investor and an LP in a VC PE fund? Maybe Lee can take this one.
Well, I can take a first stab on that. From my observation, there are probably 3 or 4 major differences between a SPAC shareholder and also an LP in a VC or PE fund. Number one, the time horizon is very different. A SPAC investor's time horizon can be as short as a few seconds or as long as forever. But an LP in a PE fund, you have a fixed time horizon of 7 to 10 years. Number 2 is voting rights. A SPAC investor or a shareholder does have voting rights. LP does not. And number three is, I think the liquidity differences is there. For example, a SPAC shareholder, your instruments are traded in a public market. You have a publicly available market to buy and sell. But the LP's share is in a private market. There's no readily available market. So that inherently will have a 30 to 50% illiquidity discount depending on the sector or the industry or the stage you are in. I think lastly, probably the fee structure. LP certainly pay a fee of 2% a year and then 20% carry, so on and so forth. But the SPAC shareholder does not pay a fee, but they are subject to, like Lisa said, the 20% dilution during the merger or de-SPAC process. There are differences.
Thanks, Lee. Next question. Are you seeing a lot of SPAC funds? That means funds investing in SPAC, IPO, and PIPE. What do you think their value proposition are?
Money.
Anyone want to touch base on this one?
So we do see some funds getting started on their SPAC specific funds. I think investors are just looking for returns, right? And this is a pretty well protected vehicle, I would say, because you can invest in a SPAC and just look at the sponsor's reputation, credibility, track record, and which sector they plan to invest in. You know, although they don't require a full S1, but they also have to show you their credentials and plans. And once they go public, and if they can't find companies that you like, or you know, you just want to get out of it, you can redeem your capital at any time. So it's pretty well protected. So I think that's kind of why the funds are looking to invest in SPACs, because sometimes they find some companies, you know, like Rob said, some ESG related companies, they really take off after 5 years. They have really good outlook. And then if you're a long only investor, you can invest in that type of assets and with good protection.
Thanks, Lisa. Next question. Well, I think this one, the previous slides we were showing explains a little bit, but probably we can elaborate a little bit on this one. So what happens to the SPAC when the planned acquisition does not take place?
I can answer that one. It depends on the life cycle that's left of a SPAC. So a SPAC usually has 18 to 24 months to complete an acquisition. So if a deal does not happen early on that life cycle, and this has happened quite often, you just don't hear about it because it's at the letter of intent stage or the definitive agreement doesn't get signed. The SPAC sponsor goes on to the next deal, has wasted a bunch of money seeking to try to close that transaction. And the target company, unfortunately, has invested a lot of time with lawyers and accountants and bankers and others. So it's a big expense. But if the PIPE subscriptions are signed up, then the deal will happen because there's the money to support it. So you'll know probably within 2 months from starting on the process. Maybe, you know, as Lisa said, PIPEs are taking longer. So maybe you know in 2.5 months, 3 months. But
thanks, Rob. Well, next question is very complex. Well, we only have time for 1 or 2 questions, so probably today is not the most suitable day to answer this question here. But at the time I was preparing today's session, I realized there are so many questions to ask. Yeah, today we only get a chance to answer a few. I'm thinking of having a follow-up event in the future to dive deep on SPACs. I actually created a poll here, and I will put it out. I will launch it here. So I would like to know, so which topic interests you the most? We can, for our next event, we can go from a cross-border or international perspective, or we can dive deep on the practice in law or tax, or we can go from an institutional investor's point of view. So for audience and a panelist, if you're you're up for voting, and please let us know your thoughts, and we will see what we can do from there. And while everyone is voting, maybe we can use this time to move on to the next question. So next question is from William Lee. First question, some company have A share and B share, and one type of share have more voting rights. This is structure to ensure the founders to keep control. Is this structure still allowed in SPAC's IPO?
I'll try to answer it.
Yeah.
It's subject, if you're on the private company side, it's subject to negotiations, and whether or not the bank that's pushing out the PIPE transaction thinks that it'll be well received in the marketplace. So you can do it. I'm just not that familiar in the past year or so of that, of anyone doing the two types of classes. But traditionally, you do it in lots of IPOs. So I don't think there's an issue.
Thanks, Rob. The next one. Is there a SPAC-like process to go IPO in other countries, such as China, Hong Kong, Singapore, or Europe?
Well, I don't think it's exactly like SPAC so formal. But 借壳上市, that's a very common concept throughout, Asia, right? I mean, so thinking about a lot of companies going to China in the last few years and using a shell and become public listed on A share. I mean, similar things happening in Hong Kong as well. So yes, it's possible, but it's not as regulated, as formal as in the US.
Yeah, from my observation, I think when we talk about SPACs, we're really talking about SPACs here in the US. Because, I mean, there are only several countries in the whole world have SPACs because they have the sophisticated, highly developed capital market to support SPACs. Even in UK, their SPACs are different from what we have here. Shareholders don't have voting rights, and the IPO process is much quicker, and the fee structure is so different. We're really talking about the US SPAC here, and this is where things are happening.
Yeah, and I think the point is it is US listing, but the company can be anywhere, right? It's a US listing. You can be Asian, Cayman, UK, Italian, or whatever type of company can be US listed.
Great. So the next question, we probably only have time for one or two questions. So, well, let's go with this one first. So for growth startup, want to go SPAC path, is banking the starting point to start looking for a sponsor or other better channels? I think the question here is, what are the best channels to start looking for sponsors?
Lee probably does a lot of that, right? And
I think everyone on the panel can be a good resource for the client, because you want to talk to as many kind of people in the circle as possible to find out the right sponsor for you, because SPACs are typically in a specified sector. And so I'm open to other panelists' ideas as well.
Yeah, I agree. Anyone can be, you should speak to accountants, lawyers, bankers, get an education, find out what the different variations are out there. Because even though a SPAC sponsor may be focused on one industry, I always say there's a little footnote that says, however, we'll do whatever makes sense and wherever we can get value. So, I've seen one SPAC that was focused on technology and did a real estate deal. So money will go anywhere.
Yeah, I mean, I have talked to many of my clients and eventually convinced them not to do it. You know, it's not for everyone. First of all, I mean, and it's very important to make sure you're ready to become an adult, I would say. So there's a lot more work, you know, ahead of you. So that this is important step, right? Just be ready.
Yeah, same here. We've convinced a lot of people don't do it actually. But what we do is, you know, if we think this company, if the client wants to learn, you know, we have we maintain a database of all current SPACs who are looking for targets. We have who the founders are, which sector they're looking into, what are the sizes. So yeah, so we can do some screening for clients. That's kind of our starting point.
Well, thanks everyone. We're running out of time, so we will just review the poll result here. It seems most of the audience are interested in the cross-border perspective. Maybe that's because JJ Lake's followers, most of them are from the cross-border perspective. They are entrepreneurs in that angle, so that's why they want to hear more about the cross-border points of view.
Yeah.
Yeah. Probably next time we can do a session specifically focusing on that part to get to know more about the international part. All right, but we will see what we can do. Let me stop sharing here. Yeah, it's time to wrap up. Yeah, I mean, thanks everyone for joining us tonight. Thanks for every audience, and a special thanks to our panelists. Thanks for taking the time to join today's session and share your thoughts. Thank you all, and you all have a great evening, and I hope we can see you all soon.
Bye.
Thank you, guys.
Thank you.
Bye-bye.
Bye-bye.